We're live, sir. We'll start in next 1 minute because it's 6:59. So we sharp start at 7 o'clock. Let's wait for the participant to join.
Yeah, sure.
All the participants will join at YouTube only. Good evening, friends. Myself, Sangam Aggarwal, and I welcome to on this very important session, financial instrument Ind AS 109 and Ind AS 32. So, friends, as you know that we are providing you online sessions from last 3 months. We have also done one 8-day course of Ind AS. So now we are come with some different sessions on the Ind AS. Currently, we have covered overview of Ind AS. We have already covered two more Ind AS, and today we are going to cover Ind AS 32 and 109. And for upcoming Saturday, we are going to discuss Ind AS 115. That is basically revenue recognition for contracts from clients, customers. So, friends, we are. This is our endeavor to enhance the knowledge of our all professionals so that they can perform their professional work in the best possible manner. As we all know that we are in a phase in the month of July where generally we are required to finalize the financial statement of any company. And nowadays on many companies, Indias are applicable, and somehow deep understanding of Indias for a chartered accountant and for a professional is very important, because until unless we don't have a good knowledge of Indias, we cannot prepare our financial statement in the best possible manner. And being an auditor, it is difficult for us to do audit according to the accounting standard and the Indias. So, friends, in this series, we bring all these Indias so that we all have a good understanding and prepare our financial statement and perform our statutory audit and other certification work in a best possible manner. So, friend, today we have CA Anil Chachra sir. He is an expert in Ind AS. Today he will discuss Ind AS 109 and 32. So, friends, hope you will like today's session. So, friend, you can ask your question in the comment section. We will take your all the question in the last session is around 90 minutes, and post 90 minutes, around 10 minutes, we will take all the questions. And friends, whatever PPT we will use in today's session, the link I will upload in the comment section. You can download from there directly. And friends, I request all the viewers kindly subscribe our channel and click on the bell icon so that you can get the information of upcoming sessions. And friends, we already have more than 40 sessions on different topics that includes Companies Act, income tax, Ind AS, and many GST and many other sessions. So I request you can also go through those first sessions and enrich your knowledge. So I am not taking much time and going the brief profile of Anil ji. CA Anil Chachra sir has 13 years of vast experience in uh, uh, accounting standard and Ind AS. He is also qualified diploma in information system audit, diploma in international financial reporting standard. He is also qualified chartered certificate course of valuation. He did his BCom from MD University Rohtak. Apart from that, friend, he has handled a very good and major clients like Jury Agrochemicals, IHHR Hospitality Private Limited, Indian Global Indian Private Limited, Entry India Project Private Limited, and Grant Thornton. So he had worked with the various company, currently working as an independent consultant and providing conversion of Ind AS of their financial statement and providing day-to-day consultancy to the number of clients. So, friends, I hope you like today's session. You can ask your queries also. We will try to make this session interactive. So, whenever Anil ji asks any question, please try to give your answer in the comment section, and we will share your answer with Anil ji so that we all have a greater understanding over the subject, and also session become interactive. We will try to make this session a two-way communication instead of one-way communication. Although it is an online platform, but still we will try to make it online. You can ask your question in the comment section and reply in the comment section only. So I am not taking much time and invite Anilji to take this session forward. Over to you, sir.
Thanks, Sangam, for the brief introduction part. Good evening and welcome to all of you who have joined this webinar on the financial instruments. So, friends, it is a very good and complicated topic. So we will try to have a very good conversation on the today's discussion, which is relating to the financial instrument part, right? So let me share the screen, and then we will uh, have a discussion on the financial instrument part. So the agenda for the today's session is just to have an overview of the financial instruments, right? So we will discuss basically in next 1.5 hour session relating to the financial instruments overview. We will discuss about this Ind AS 32 part first. Means what is the definition of the financial instruments, uh, financial assets, financial liabilities. Uh, what is the difference between the liability and the equity instruments? Then we will discuss about the compound instruments. And in one or two part relating to the one Ind AS 109 relating to the classification and the measurement part. Then we will discuss about the disclosure part as well. So that is the today's agenda for the next 1.5 hour session. So let's start our discussion relating to the financial instruments overview and scope. So in the
Anil,
mean in
can you do in the presentation mode by doing F5?
yeah.
Please.
So
Yes.
yeah, okay. So let's start our discussion relating to the financial instruments, right? So overview and scope. In the meantime, if you have any questions, so as Sangam mentioned, that you can write into the comment box so that we can have or solve sort of your query relating to the financial instruments part. So financial instruments overview. So when we talk about this financial instrument overview, three standards are applicable. So one is Ind AS 32, which talks about this financial instrument presentation part. Another is the Ind AS 109, is the financial instruments, classification and measurement, hedge accounting, embedded derivative. So all parts are covered under the Ind AS 109 part. The third one, which is the disclosure part, is the financial instruments disclosure. So there is a separate standards has been given for the disclosures part for these financial instruments. So this Ind AS, so when we talk about this Ind AS, we need to understand all the three standards on a simultaneous basis, on the mutual basis, because you can't understand one topic without the other. So that's why the discussions is required by combining all the three standards. When we talk about this IFRS, there are also three standards, which is one is the IS 32, which is a replica of Ind AS 32, IFRS 9 in Indian part, it is Ind AS 109, and the disclosure part, which is IFRS 7 in India, it is Ind AS 107. So all standards are same except one or two carve out which has been adopted by the institutes. We will discuss later on. So the three standards part, the Ind AS 32, Ind AS 109, and Ind AS 107 has specified their own criteria for the discussion part. So one is the Ind AS 32, which talks about the presentation part. So Ind AS 32 basically talks about the definition of the financial instruments, means what is the definition of financial instruments, what are the financial assets, what are the financial liabilities. Then it talks about the offsetting rules, means whether the financial assets or financial liability can be offsetted or not. The third thing, which is the most important thing in this Ind AS 32, is the recognition of the interest and the dividend part, right? So three broad criteria will be discussed in the Ind AS 32 part. Ind AS 109 talks about the five major parameters, right? So one is the recognition of the financial assets and financial liabilities, classification of the financial assets and financial liabilities, measurement of financial assets and financial liabilities, derecognition of financial assets and financial liabilities. Derecognition means that if you have sell your financial instruments, financial assets, then how would you derecognize the financial assets into your books of account? Impairment model, expected credit loss model. So how would you recognize your expected credit losses into your books? And the fifth one is the hedge accounting. So these five parameters has been described or has been prescribed under this IFRS 9 or Ind AS 9 part. The third is the disclosure part, as we discussed. The disclosure has been mentioned in the 107, Ind AS 107. So there are four standards which has been issued by this Indian Institute, which specifically deal with the disclosures part. One is relating to the Ind AS 1112, which is relating to the disclosures of the consolidations. Ind AS 107 is one of the disclosure standards which has been specifically issued, which talks about the disclosures of the financial instruments. Because when you see the balance sheet of the Ind AS or IFRS, most of the disclosures are relating to this financial instruments only. 50 or 60% time you have to spend on this 107 part. Another standard which has been exclusively dealt with the disclosures part is the Ind AS 24, which is the related party, and another is the 108 segment reporting. So 107 is one of them, which is relating to the disclosures part. So in the today's agenda, we will discuss about this Ind AS 32 part on the exclusive basis, means classification, the definitions part, offsetting rules, and how to recognize interest and expense part and dividend part, and two items relating to the Ind AS 109 part relating to the classification of the financial assets and how to recognize or to measure the financial instruments, which will cover your 60% coverage for the 109 part, and then we will discuss the disclosures parts, right? So that is the agenda for this today's session. So now let's discuss about the objective and scope of this Ind AS 32, which is the presentation part. So each and every standard is having their own objective as well as the scope part, right? So each and every standards. So when we talk about this financial instrument specifically, whether it is Ind AS 32 or Ind AS 109, objective might be different, but the scope would remain same, because whatever the item which has been given under this 109, the same will be covered under the 32 as well, right? So objective might be different, but the scope would remain same. So objective of this Ind AS 32 is basically how to present the financial instruments in terms of liability or equity, and of setting rules for relating to the financial assets and financial liabilities. This is the second thing. Third thing is the classification of the related interest, dividend, losses, and gains, right? So why this is important, classification of this interest or dividend? So as we discuss later on about the difference between the liability and equity, in that case the dividend will become the interest part, right? So we will discuss in a very detailed manner. So that is the objective. Three things we will cover under this Ind AS 32 part. Now come to the scope part, right? So this standard, so every standard, each and every standard has set up its own scope. So Ind AS 109 and 32, the scope would remain same, but might be 2 or 3 items has been added extra in the 109 part, because 109 is relating to the measurement part and the recognition part. So this standard will apply to all type of financial instruments except some item has been excluded from the purview of the Ind AS 32. One is the interest in subsidiaries. Means if you have an investment in your subsidiaries, subsidiary includes your associates and JV as well, wherein you have to apply Ind AS 1110, Ind AS 28 as per the equity method accounting, or Ind AS 27, separate financial statements. So Ind AS 32 says that whenever you have an investment in terms of subsidiaries or in terms of the associate part, this standard will not apply, because Ind AS 27 says that you need to measure your investment at cost. So whenever you will apply the cost method to the consolidation part, investment in the consolidated entities, then this standard will not get applied. So that means the investment in associate and the subsidiaries and JVs will get excluded when applying this Ind AS 109 as well as Ind AS 32. Second thing which has been excluded from this scope is that employers' rights and obligation. There's a separate standard for this Ind AS 19 employees benefit part. So whatever the rights and obligations, all disclosures and the measurement part has been categorized or has been specified under the separate standard, which is called the Ind AS 19 part. Third thing is the insurance contracts. Whatever the insurance contracts is being there, because the separate standard has been prescribed for the insurance contract under 104, Ind AS 104. So insurance contracts are not part of these financial instrument parts, right? So Ind AS 32 as well as this Ind AS 109 has excluded the insurance contracts, but this standard will get applied wherein there is some derivative which has been embedded in terms of the insurance contract part, or we can say that the embedded derivative. So all embedded derivative will be covered under the Ind AS 32 as well as the Ind AS 109 part. Share-based payment transactions, separate standard has been there, one under the Ind AS 102. So share-based payment transactions has been excluded. So under this 102 part, Ind AS 102 part, three methods have been prescribed. One is relating to the cash basis method, second is your equity method, and third one is relating to the alternate method, whether you can choose the cash method or the equity method. So share-based payment transactions has been excluded from these financial instrument standards in both sides, Ind AS 109 as well as 32. So but this standard shall apply. This is a complicated thing, which I am going to discuss this. So it will be better if we can explain in a much detailed manner. This Ind AS 132 as well as 109 will get applied to non-financial items. Please focus on the word non-financial items that can be settled net in cash or another financial instruments or by exchanging financial instruments, right? As if the contracts were the financial instruments. So suppose you are dealing with in a commodity market, right? You are trading on the MCX or NCDX. You are buying a metal. You are bidding on the metal industry. So in that case, this is your non-financial items. If your intention is that you want to settle on a net cash basis, means you don't want to buy or sell, right? So you don't want to take on the physical delivery basis, then this standard will get applied because that part will be covered under the derivative part, right? So standard says that as and when your intention is that you want to settle net in cash, only and only in that case this standard will get applied, whether it's 32 or 109. But some exception rule has been mentioned, which states that if you want to take it as a delivery part for your own expected usage purpose, then this standard will not get applied. So what is the difference between this first and the second part? First part says that it will be your derivative because you don't want to take in on a delivery basis. You will settle in the MCX or NCDX market. You will pay net amount. That will be your financial instruments part. But in case you want to take a physical delivery, that will become your normal sale purchase. So that means this will be covered under your IS 37 or Ind AS 37, wherein you can specify it under the executory contract part or onerous contract part. It depends upon the condition to condition. But when we talk about this net settlement part, right, net in cash or another settlement part, so standard has prescribed various conditions. What is the meaning of net in cash? Net in cash means that, okay, I don't want to take a delivery, whatever the difference it would be there, I would settle in the market. That is your net in cash. But standard says that apart from this net in cash, there are the other certain conditions you can take it in the meaning of the net in cash method. Means if you have taken a delivery, that can be readily convertible into the cash in the near future. Near future means might be in 3 days, 4 days, 5 days period of time. That will also covered under the net in cash method. So suppose you are doing an audit, right? So how would you differentiate between these two things? Whether the company want to settle in net in cash or they want to take a physical delivery. And if the financial reporting is at the near end, or suppose you are doing your 31st March or 31st December accounting. So how would you ensure this type of transaction, whether this Ind AS 32 or 109 will be applicable or Ind AS 37 will get applicable? So that is a challenge for the auditors as well. How would you justify those things? But where the company wants to measure these contracts under the fair value method, the company can do it. If the company can prove that, okay, this fair value method will eliminate my accounting mismatch, so this fair valuation will get applied. So three things. One thing is that if you want to settle net in cash, means it will be part of your financial instruments category under the Ind AS 32 as well as Ind AS 109. If you want to settle in as if you want to take as a physical delivery as an expected usage method, then it will not get applied under this Ind AS 32 as well as 109. The third thing is that if you want to apply the fair valuation at your own discretion level, as an industry person, I want to take it as an fair valuation method, I can do it. There's no bar or there's no harm to apply the fair valuation method, right? So fair valuation means it will automatically get covered under this 109 as well as 32 part. So let's take one example just to understand this concept relating to the expected uses as well as the net cash settlement part. So XYZ Limited enters into a fixed price forward contract to purchase 1 million kilogram of copper in accordance with its expected uses requirements, right? The contract permits XYZ to take physical delivery of copper at the end of 12 months or net settle in cash basis on the changes in the fair value of copper. XYZ intends to take delivery and has no history for the similar contracts of settling net in cash or taking delivery of the copper and selling it within a short period after delivery. So now the question is the contract within the scope of Ind AS 32 or 109? So my intention is that I want to take a delivery, right? So what would be the answer for this query? I want to take it to delivery as per my expected uses. So that means as and when my intention would be to take a physical delivery of this product, so it will be out of scope from this Ind AS 109 as well as 32. I have to apply the accounting under the normal method, sale and purchase method. I will make a provision as per this Ind AS 37, or it will be part of my executory part, executory contract part. But where this in this question the company wants to apply the fair valuation method, yes, they can do it. There's no harm about it. So it's depend upon company to company. But for the auditor point of view, you need to discuss, because this type of the transactions is a very complicated one. As and when you apply the non-financial items transactions on the stock market as well as the commodity stock markets, right? So these things you need to keep in mind while doing the audit of this type of the transactions, whether this will be part of 32109 or some other standards, right? Now come to the main part. As the topic is today's topic is financial instruments. Now the question should come into our mind, what is the financial instrument? So 32 has prescribed the definition part. So right, so this in the next 10 or 8 slides, 10 or 12 slides, we will discuss about the definitions parts only relating to the financial instruments, keeping in the practical aspects. So financial instrument is any contract. Please specify the word any contract. Contract could be your contractual rights or contractual obligations. But when we will talk about this contractual right or contractual obligation or the contract, whether we need to have a signed copy of contract or a verbal copy of contract, the standard says that it should have the commercial substance, but it doesn't mean that you need to have the written form of a contract. So that means it could be a verbal contract as well, but it can be enforceable in a court of law. But some sort of document or some sort of agreement should be there, like in case of the sales that you are doing with your parties. So some sort of sales order, some sort of invoice wherein the conditions would be mentioned about the commercial part. Okay, you need to make a payment within 45 days, 30 days, 70 days, right? So everything will get mentioned. So this will can also suffice for the contract part as well. So any contract that gives a financial assets of one entity and a financial liability or equity instrument of the another entity. So now three things has been covered under the financial instrument definition. Contract means the contractual right or contractual obligation. It could be a written, it could be verbal form, but that can be enforceable in a court of law. Three definitions we will cover: financial assets of one entity, financial liability or equity instrument, because all this standard revolves around these three definitions only. What is the financial assets, financial liability, and equity instrument? Because in your balance sheet, 80 or 90% criteria or 80 or 90% time you have to spend, it is my financial assets or non-financial assets, financial liability or non-financial liability. But in terms of the complication part, we need to identify the liability can be converted into equity or not. So that's why these three definitions is most important. So examples of this financial instrument could be, what's a contractual, right? So in terms of the financial instrument, trade receivable is the very simple example, wherein you have to receive a money back from your customers. Trade receivable is your financial instrument. Payable, you have to pay. Means trade receivable is my financial instrument. It's a financial assets for me and financial liability for the other party, because it's giving us some sort of contract in some sort of sense that an instrument which gives a financial assets to me and the financial liability to the another entity. So whatever the trade receivable is my financial assets, trade payable will be the financial liability for the other party. Equity instruments means the investment that you have made in your another industry, except investments in the subsidiary or the joint venture or the associate part, because that has been excluded from this scope. So derivatives, so we will discuss later on about the all parts, but this is the basic and simple example of the financial instruments. Now let's discuss one by one definitions in a very detailed manner. What is the financial assets, financial liability, and the equity instrument? First, we will discuss about the financial liability part. What is the financial liability? Trade payable, as we just discussed about the trade payable part. What is a trade payable? Means you have a liability, you have to pay something to your another party. Trade payable, right? It's come to the contract part. So the thing is that that should come through the contract part. Now let's focus on the definition part. Two parts has been mentioned under the standard. One is the contractual obligation. Trade payable is your contractual obligation. You need to pay. Bank loan, you have taken a loan from the bank. It's a contractual obligation. You need to pay. It's a very simple definition, right? First part is very simple. So contractual obligation to deliver cash or another assets to the another entity. So 80% of the coverage would focus on the cash or the financial assets to the another entity, right? So trade payable means you will pay through bank or cash, right? So this type, whatever the you have to pay through cash or through bank or some sort of other financial instrument mode, that will become your financial liability because it's a contractual obligation. You can't avoid to deliver the cash, right? Or to exchange financial assets or liabilities under potentially unfavorable conditions. It's a bit complicated. To exchange financial assets or liabilities under potentially unfavorable conditions. What is the unfavorable conditions? Suppose I can take you through this example. What is this unfavorable conditions? A Limited has issued a call option. Call options means option to buy. Put options means sell. So A Limited has issued a call option to Mr. X to subscribe to A Limited equity shares at the price of 50 per share. And this call option is to be settled on a net basis. That is, there need not be physical delivery of the shares. Means it's part of the your derivative part. Now, if at the balance sheet date, the market value of the equity shares A Limited is 55 per share, A Limited will be obliged to pay 5 per share, right? So 5 per share you have to pay under the settlement mode. Because this is your unfavorable part. So that means you need to pay 5 rupees per share to the second party. Such condition would be your unfavorable and you recognize a financial liability in your books of account. So this will become your financial liability. It's under contractual obligation. So contractual obligation could be whether you will deliver through your cash or to exchange financial assets or financial liability under potentially unfavorable conditions. That is the first part. Second thing might be that you will settle the liability under your own shares by issuing their own shares, by settling by own shares, right? So that could be the situation. So what we have to do in terms of the conditions or in terms of the criteria wherein the liability will be settled through the own equity shares, own equity instruments. So under the liability part, if I have to settle my liability by issuing own equity shares, that it will cover a liability only and only when the it's a part of non-derivative for which the entity is or may be obliged to deliver a variable number of entities own equity shares. Means I have to deliver the shares in variable form. There's no any fixed part. Suppose my liability is 100. I will issue as many as number of variable shares. There is no criteria fixed how many numbers I will issue to settle my liability. That will be my financial liability part. Or a derivative that may be settled under the exchange of fixed amount of cash. Means I will settle my liability at the settlement date on the basis of the price which will come from the market. The price is not fixed. Today's my liability is 100, but might be that my liability will be linked to the future price wherein the amount will get fluctuated. So in that case, the two things, I will issue neither my number of shares has been fixed, neither my amount has been fixed. So in that case, the liability will become my financial liability. So you want to clear it through the cash method or you want to issue by shares. So in case of the issue of the shares, neither your amount is fixed for the settlement part nor the number of the share is fixed. Means number of shares are variable. So as and when the number of shares are variable, the liability will become my financial liability. So that is the definition of the financial liability part. Now come to the financial assets. When we just opposite the definition, or when we reverse the definition of the financial liability, it will become my financial assets. So what is the definition of the financial assets which has been prescribed under the standard? The first thing is cash. So why the cash is my financial assets? Because cash is in my hand. So standard says that cash is a medium of source where through which you will incur the expense, through which you will incur your investment. So cash by default will always be your financial assets. Equity instrument of the another entity means investment that you have made in some sort of the bonds, debentures, or equity instruments, right? So that will become your financial assets. Except investments in the subsidiaries, associates, and joint venture part that has been excluded by this standard. Contractual right. So under the financial liability part, it was a contractual right to contractual obligation for the payment part. Under the financial assets, it will be a contractual right to receive cash or another financial assets to the another entity, or to exchange financial assets under the favorable conditions, just opposite the definition of the financial liability part. Third thing might be that you will settle your financial assets not by cash, not by bank, to other sort of instruments as well. Just as we discussed in the financial liability part, you will issue the shares. But might be that in case of the financial assets, you will receive the shares, right? The content is same, the intention is same. So in case of the financial assets, wherein the contract that will may be settled in entity's own equity instrument, the same thing, you will obliged to receive a variable number of shares, on shares, or the amount is not fixed, right? So a derivative that will may be settled other than by exchange of fixed amount of cash or another financial instruments for a fixed number of entities on equity instruments. So two things: the number of shares are not fixed, and the second thing is that the equity, and the second thing is the number of amount is not fixed. Number of shares as well as the number of the amounts are not fixed. So all these criteria will be part of my financial assets. So when we discuss about this financial assets as well as the financial liability, 80% normally company do is that they normally prefer to settle it by cash, so it will become your financial liability. But in some sort of the complicated conditions wherein the company need to issue the shares, then we will need to see whether the shares part, whether the whether we are going to issue on a variable basis, or the amount is fixed, or the amount will be linked to your future index, wherein the amount is will be fluctuate on the day-to-day basis. So that will be part of your financial, either will become your financial assets or either it will become your financial liabilities. Now come to the equity part, right? So it's a combination of these two things, financial assets and the liability part. Mostly it's related to the liability part. So under the financial liability, there was a contractual obligation. You need to pay, right? Trade payable is the best example. Creditor is the best example. Bank loan is the best example that you need to pay to the bank, to the parties, right? But under equity, there's no any contractual obligation. What type of the contractual obligation? To deliver cash or another financial assets to the another entity. There's no any obligation from my part. That means this is my equity. So balance sheet, under the balance sheet part, specific criteria, specific classification has been there for the liability as well as for the equity part. So that's why this classification, this discussion is very, very important. Or to exchange financial assets or liabilities under potentially unfavorable conditions. So means there's no any contractual obligations. Whenever there's no any contractual obligation, it will be part of my equity part, right? This is the first thing. Second thing is that my contract will get settled by issuing my own shares, own equity instruments. What will happen in terms of the equity? So as we discussed about the financial liability part, wherein the number of shares would be variable, wherein my amount would be variable, means not fixed. But in case of equity, if my number of share is fixed as well as my number of my amount is fixed, means for 100 rupees liability, I will issue, suppose my price is 10 per share, I will issue 10 shares, right? So that will my equity. It is called fixed for fixed rule or fixed for fixed criteria. So as and when my transactions will get made by fixed for fixed rule, I will classify that transaction into the equity part rather than the liability parts. One first thing is that the obligation part, it is clear, right? Between the financial liability and the equity part. In the liability part, there was a contractual obligation. In equity part, there was a no contractual obligation. As far as the on the settlement of the liability by issuing your shares by own equity instruments, if my number of shares is variable or my amount is not fixed, it will be part of your financial liability. In all other cases, means if my number of shares fixed as well as my amount is fixed for the settlement part, it will be part of my equity. So that's the difference between this liability and equity part. But under this IFRS versus the Ind AS part, there's a one carve out. In case of the foreign currency convertible bonds, right? Foreign currency convertible bonds, wherein you will settle your liability by issuing, or because the conversion option is there, right? So you need to convert your foreign currency convertible bonds into the number of shares. The question is, how would you classify this foreign currency convertible bonds, whether it's your equity or it's your liability? Under IFRS, it is a part of liability part, because the number of shares is not fixed, because the foreign exchange fluctuation is there, or you will issue the number of variable shares, the part is not fixed. But the India says that India has taken the carve out approach, which states that the FCC part, the foreign currency convertible bond part, will be taken as the equity component rather than the liability component, right? So this is just a one carve out between these Ind AS as well as the IFRS part. So that's the definition of the equity, right? So we have discussed about the financial instruments. Then we discussed about this definition of the financial assets, financial liability, and the equity part. Now let's take examples. So guys, please read out these examples, and if you have any queries, then we will discuss whether it will be part of financial assets or financial liabilities. Investment in equity shares, right? So investment, although I have mentioned the answers as well as reasons as well, but you just see the left part, means the item part only, and think about yourself whether it's part of your financial assets and financial liability, keeping in mind the definition part which we have covered, right? Contractual part, contractual obligation, contractual not obligation. So you need to keep in mind while classifying these transactions under these three categories: financial assets, financial liability, or equity part. So investment in equity shares, by default, it is your financial assets because it's fulfill my definitions. If it is your if your investment into the in the joint ventures or the associates, then it will get excluded. Investment in bonds, same thing, it's my financial assets. Bank balance, bank balance means you can have a right to draw the balance from the bank, right? So it's a contractual part, fulfill the definition. Inventories, or you can say that property, plant and equipment, tangible, intangible assets, will never be part of my financial assets, right? It's a non-financial item. So as you see the Ind AS balance sheet, which has been prescribed under the Schedule 3, so you need to classify your balance sheet into the two parts, in different parts: financial instruments, non-financial instruments, right? So whatever the items which is being there on the financial instrument parts, you need to categorize all the items into one part: current financial instruments, current financial assets, non-current financial assets, right? So you need to mention all these things. Prepared expenses, so whether this prepared expenses is my financial instrument or non-financial instrument, or financial assets or non-financial assets, it will always be your non-financial assets. Why? Because through the prepared expenses you will receive the service or product. There's no any chance to get the cash back, right? So it will always be part of your non-financial assets. Advance given for goods and services, advance given. So because in the corporate nature or corporate cultures, company normally, what happens is that a company normally transfer the amount to the in the form of advances to the vendors. So against the advance you will get the services or the product, right? So it will always be part of non-financial. But suppose in case of the advance which is refundable, so in case of the refundable part, it will be your financial assets. Deferred revenue, right? Means you have recognized in advance that will be impacting in my future. You will not get any money back. So that will be my non-financial assets. Income tax. So can anyone let me know income tax would be your financial or non-financial assets? Why it's non-financial assets? Because it's not a part of a contract, it's a part of a statutory. Now let me put one question against you. Sale tax incentive. Suppose I have set up an industry, right? And the particular unit, particular state government has committed me that I will get a refund in some in sort of sale tax exemption. Now the question is, the sale tax exemption or incentive, whatever you want to say, sale tax exemption or incentive would be my financial assets or non-financial assets? Can anyone from you let me know about the answer of this question? The income tax or sale tax incentive part. See, sale tax incentive, first of all, this statutory, these are part of the statutory liability. There's a two things, 2 points we can discuss. It's a debatable issue. Income tax is always part of statutory. Whatever taxes or whatever item which is part of the statutory nature, it will get excluded from the financial instruments part. But in case of the sale tax exemption or incentive part, might be that you will get some sort of incentive in terms of cash or in terms of money you will get back from the government. Now the question is, although it's part of my statutory assets, but can I say that as and when I set up my industry, my state government committed me that I will get a money back? So that means some sort of agreement would be there. So it can become your contractual right to get the money back from the government. So that can be your financial assets, right? That can be your financial assets. Financial guarantee. What is the financial guarantee? Financial guarantee means suppose my parent has given a guarantee to the bank on behalf of the subsidiary. If subsidiary doesn't pay to the bank, the liability will get fall onto the parent part. So that means it's a parent liability to give the money to the bank in case of default by my subsidiary. So that will become my financial liability, financial obligation. I have to pay to the bank. So that is my always be my financial liability part. Trade and other payable. It's a very simple thing, as we discussed at the start of this discussion. It is your financial liability means fulfill your definition. It will be part of financial liability part. So through this analysis or these type of discussions, we can analyze one by one in terms of the balance sheet part, whether it would be your financial assets or whether it would be your non-financial assets, right? So might be that some sort of complications would be there. But you need to apply your judgment as well as the definition part while classifying the assets into financial as well as into the non-financial part, right? So under the definitions part, financial assets, financial liabilities, and equity. Why it is important? The difference between the equity and liability, why it is important? The presentation part will get changed, right? The presentation part for the equity or the liability will get changed as far as the balance sheet part is concerned. Then the measurement part will get different, will get differentiate. Means under the 109 part, the liability we have to classify under the different method, and the equity we have to measure out under the different method, because the liability you have to remeasure at the year end, but equity you don't need to remeasure at the year end. So that's the difference. The third thing is that, which is the most important, treatment of interest and dividends. Means if I am paying a dividend, and suppose in terms of the preference shares capital, right? Why it is important, this the difference between the liability and equity? It will be applicable in most of the cases relating to the preference share capital part, preference shares, we can say that, right? Whether it will be my liability or whether it will be my equity. So as and when under the I gap, there's a no any difference, right? So preference shares mean preference shares you will show under the equity portion, but under this Ind AS as well as under the IFRS part. If we have to see the terminology or the rights which has been attached to the while issuing the shares, whether it's a redeemable or not redeemable. What are the other rights? Means whether we will get the dividend or not to get the dividend. So this type of the matters we need to discuss while classifying whether my liability will be, whether my particular transaction will be covered under the liability part or a particular transaction will be covered under the equity part, right? So that's why dividend will become my interest as and when I will classify a liability into equity into the liability part. Or we can say that the equity transactions means what are the transactions? It's a residual value after deducting all my liabilities. So as and when we need to do this classification, we need to apply the liability, then we will calculate the equity method we will discuss in the later slides. So that's why this differentiation is required under the all the three standards. So as we already discussed about this, the obligation part, as and when there is an obligation, it will be your liability. Otherwise, it will be your equity. If you have any unavoidable contractual obligation, yes, liability. Otherwise, it is your equity part. So now taking the example of these preference shares as we discussing in the last slide, liability versus equity classification. Suppose a company has issued preference shares. Firstly, we have to see the rights. What are the rights which are attached in while issuing the shares, whether it's a redeemable or irredeemable. Suppose the shares are redeemable form, preference shares are redeemable form. So that means I have a contractual obligation to pay cash. It will be my liability. Under the I gap, it is your equity. But under this Ind AS, redeemable will become your liability portion. So as and when you will pay the dividend to those preference shares, that will become my interest part, right? So under Ind AS 1, you need to show under the finance cost, whatever the dividend you have paid to the redeemable preference shares, the redeemable preference shares will get classified to the liability part and the interest portion will get merged into the finance cost as per the Ind AS 1. So that's why this classification is important. This is the first of thing. Second thing is that what are the other rights which has been attached while issuing the preference shares? Means suppose in case of the dividend parts we need to see. If suppose the shares are not redeemable, okay, but we have to pay the dividend. Dividend is mandatory. So that means still there's a contractual obligation. I need to pay the dividend in sort of cash form, become my liability portion, right? So these type of the things we need to keep in our mind while doing the classification between liability and equity part. Now let's take this discussion in a more broader way relating to the equity versus liability part. So feature of the liability, as we already discussed, obligation to pay cash means in case of redeemable preference shares, you have to pay. In case of the dividend, which is mandatory, you have to pay. That is your contractual obligation. Because in accept these preference shares, the discussion is plain vanilla. There's no need to apply the logic because contractual obligation we can easily find out. Trade payable, it's easily find out, right? The advance is given, advance is received, we can easily find out. But in terms of the preference shares part or the bonds part, we need to mention, we need to check all the things. The second is the mandatory redemption, right? Preference shares redemption would be there on the mandatory basis. You have a contractual right to pay, that will be covered under the liability part. Putable instrument. What is a putable? Putable means that, see, there are the two parties. One is the issuer who is issuing the shares or the financial instruments. Second is the holder who is having the shares. So under the putable instrument part, the holder has a right to put back the shares to the issuer, can give back the right share to the issuer. So that the issuer can't avoid to pay the money to the holder. That will be your financial liability. But Ind AS 32 has prescribed certain exceptions wherein the putable instrument can be part of the equity instrument as well. So 4 or 5 paragraphs has been given in a very detailed manner why this putable instrument will be part of your equity instrument. Means if suppose all the features of all the putable instruments are in the identical form, we need to give money back at the time of the liquidation. Price is fixed for all the parties. So that putable instrument can be categorized into the equity instrument part. Otherwise, all putable instrument will be part of my liability. So on generally basis, putable instrument will be part of my liability part, right? But certain condition has been prescribed, which is called the exception rules. If we fall under the exceptions rules, then this putable instrument will become part of my equity instruments. Only a conditional right to void. What is meaning by that? Suppose I have to pay cash to my vendor. I have a conditional right to void, means I can't pay cash, but I can transfer the non-financial assets. Means I can transfer a building to my vendor for settling out my liability. So that transaction will be part of my financial liability. The standard specifically prescribe that if you have a conditional right to avoid by issuing some sort of non-financial assets for settling out that liability, that will be part of your financial liability. Indirect obligation. So obligation could be direct or indirect way. Settled in a variable number of shares, as we discussed under the very in the financial liability definition part, right? Contingent settlement provisions, wherein the amount, wherein the options would be there. Either you can settle in a cash or you can settle in sort of issue of shares. So this will happen in case of private equity or venture capital industries, wherein the P funds or venture capital will invest the money into your industry, and the term is that you need to issue the IPO, or you need to take the IPO after 3 or 5 years from their investments. If the conditions doesn't meet out, you need to pay it to cash, right? So the standard says that in case of the contingent settlement part, that will always be your liability, financial liability part, right? So these are the features of the financial liability. And in terms of the equity, just opposite the definition of the liability. Means if there is a variable portion, a variable number of shares settled in the variable number form, but in case of equity, it will settle in the fixed form. Means the amount is fixed as well as the number of shares will be fixed. The second thing is that features of the discretion over the cash payment. Means there's no obligation, right? Suppose I have issued a share, preference shares, and the discretion is held by me as an issuer whether I want to redeem the shares or not. So I have no obligation. So that preference shares will be part of my equity, not to the liability. Now come to the different scenario. Suppose the discretion is held by the holder, not by the issuer, by the holder. The standard specifically says that as and when the discretion is held by the holder, the you can't avoid to pay the cash because the holder can ask the redemption at any point of time. So that means that in that case, the liability would become into the so the redemption amount would become into the liability part, right? So two things: whether the discretion is held by the issuer, it will be part of equity. In second case, if the discretion is held by the holder, it will be your liability, right? Third thing is that fixed or fixed criteria. If I am issuing a shares in the fixed form, as well as the amount is fixed, it will be part of my equity definition part, right? So that is a liability and equity classification. Now let's take the examples relating to the equity or liability part, because this is the crux of this standard, right? This is the otherwise all the definition part is very easy. Non-redeemable preference shares with discretionary dividend. Can anyone let me know the answers of this slide one by one? Non-redeemable shares with discretionary dividend. So this, see, non-redeemable shares means I have no an obligation. So that means although the dividends is discretionary, it will always be my equity part, right? So this preference shares will get classified under the equity method. Shares that are redeemable at the option of the holder, as we discussed just now, if the discretion is held by the holder, so I have the obligation. I can't avoid the payment of cash. I have an obligation to settle that liability. So as and when the discretion is held by the holder, it will be part of my liability. Shares that are redeemable at the option of the issuer. I have a discretion. It's my intention whether I want to settle it or not to settle it. So in that case, it is being categorized under the equity part. Why this? This discussion is required? Because the private equity or venture capitalist normally invest in sort of preference share capital part, normally Series A, Series B, Series D, right? So at the time of the IPO or at the time of the capital restructuring, these shares will get converted into the equity instrument part as per the conditions prescribed. So this classification is required whether to identify or whether to classify the preference shares redeemable or irredeemable into the equity part or into the liability part. So this specifically applicable to their industries only. Irredeemable preference shares means irredeemable with contractual dividend. So we on the first part is irredeemable means I have no obligation. It can be your equity, but under the second part, my obligation is that I have to pay the cash. What will happen in that case? So in that case, it will be your liability because the contractual obligation would be there to pay the cash. Redeemable shares with discretionary dividend. Redeemable. So redeemable shares means contractual obligation. That will be your liability part, discretionary dividend. But my obligation would be there on the principal part. Although it can be part of your compound instrument, this category, this question or this issue, redeemable shares with discretionary dividend, it can be part of your compound instrument. In the next slide, we will discuss about the compound instrument part as well, right? So this will be your liability part because the principal liability, the liability is there for the redemption of the principal part. Contract to deliver as many as of the entity's own equity instrument are equal to the 100 variable number of shares, right? So variable number of shares would be your, sorry, uh, for this contract to deliver as many a variable number of shares, that will be your liability because the number of shares are not fixed. Contract to deliver, the next and the last one is that contract to deliver 100 of entities own equity instruments for 100. My number of shares are fixed, my amount is fixed. It will be your equity part. So this classification is so much important. It's very important in terms of the Ind AS 32 part. Now, as we are discussing about this classification part, it will be applicable for the issuer point of view only. Issuer means who will issue the shares, like in the case of the corporate who are issuing the financial instruments. So this classification will be applicable for the issuer, not to the holder. I am holding the investment. So this Ind AS 32 will not talk about what type of the classification will be applicable for them. Ind AS 109 will tell about the classification part, right? So that was the first part relating to the financial instruments. Now come to the second stage of this Ind AS 32, compound instruments. So as we discuss about this financial assets, liabilities, and equity, might be that in some cases a financial instrument is having both characteristics, means a liability as well as equity. But how would you differentiate? By applying the definition part, contractual obligation or not contractual obligation, as simple as that. So in this scenario we will call it a split accounting, means we need to bifurcate this transaction into the liability part as well as the equity part. So standard prescribe that how to calculate the liability part, because the equity is the residual part, right? So definition of the equity is the residual part. So that means we need to focus on the liability calculation. So this is called the compound instruments. What type of those transactions wherein you need to specify that, okay, this transaction is part of the compound instrument. Now let's discuss about the in the next slide. So this compound instrument, as I've already mentioned, that this will be applicable for the issuer point of view, right? So now let's take a very simple example of this compound instruments. Redeemable preference shares. Although one example I have covered in the previous slide, wherein I have mentioned that this will be part of my compound instrument, right? So that is relating uh, to the compound instrument part. So redeemable preference shares. Redeemable means contractual obligation. So that means its liability would be there. I have to pay the principal amount. But dividend is discretionary. There's no any obligation of the dividend. On the simple basis, I can say that okay, it's my liability. But when we talk about this compound instrument, it constitutes of two things. Liability would be there for the principal amount, but dividend is discretionary. So that means the dividend is discretionary. I have no obligations. It can be your equity part. As simple as that. Right? So this terminology we need to keep in our mind when applying this standard. This is the first of thing. Second thing is the convertible bonds. Convertible bonds at the option of the holders into the fixed number of shares. Fixed number of shares means fixed for fixed criteria, means equity part. So the interest portion which has been given, I have to pay the interest. Liability would be there. But the criteria or the condition is that I have to issue the share under the fixed for fixed rule. So that will become my equity. You just need to apply the definition part, as simple as that. There can be a number of situations wherein you can identify whether it would be a compound instrument simply basis or simple liability basis. So the standard says that wherein you have identified that a transaction wherein both the things has been there, means liability and equity, we need to identify, we need to separate this transaction, because equity is part of the equity and liability is part of the separate classification under the balance sheet. So that's why this classification is required. But under Ind AS there is no any rule, means it's part of liability, means liability. So there is no any classification required. So equity will be part of your under the SOSI, right? So liability will be part of your financial liability or financial or the other liability part. So how would you categorize? Now the challenge is, how would you categorize the liability and equity part? You don't need to apply you don't need to calculate the equity, because equity is your residual part. So standard says that you need to identify, you need to calculate the value of liability part. So how would you calculate the liability part? By taking the fair value using the rate of non-convertible rate. Means whenever we issue a convertible bonds, right? So their rate of interest will be lesser than of a non-convertible part as compared to the non-convertible debentures. Might be that I have issued a convertible debentures at the rate of 7%. But in terms of the non-convertible, which is available in the market, the rate would be higher, 10%, 11%. Because why it's less? Because the conversion option has been given to the holders so that they can convert the shares, bonds into the shares in the near future. So the standards say that you need to take the fair valuation by taking the fair value, by taking the market rate of non-convertible debentures. So that is a challenge. How would you identify what would be the market rate of the non-convertible debentures? You can identify to the market, right? To the stock rate or to the other source. And after taking the liability part, the equity would be your residual value, right? Equity would be a residual value. Now let's take one example relating to how would you calculate the liability portion. So suppose ABC issues a 2000 convertible debentures. The bonds have a 3-year term and are issued at par with the face value of 1000 per bond. So my proceeds would be 2 million, right? So 2000 multiplied by 1000 shares, 1000 per bond, it would be a 2 million. So interest is payable annually in arrears at the nominal interest rate is 6%. Each bond is convertible at any time up to the maturity into 250 ordinary shares, right? 250 means fixed for fixed criteria has been fulfilled. When the bonds are issued, the prevailing market rate for the similar debt without conversion option is 9%, right? So conversion option rate has been given, non-conversion rate option has been given. So standard says that you need to calculate the non-convertible rate for calculating your liability part. 2 million is my proceeds. I have to calculate the fair liability for whatever the outflow would be there, right? So now let's calculate the numbers for the liability part. What is my cash outflow? 6% interest would be there, 1,20,000, 1,20,000, 1,20,000. At the at the end of the year 3, I need to pay the money, or I need to convert the bonds into the bonds to the holders. But at what rate? non-market, non-convertible debt rate. So that means you're 9%. So by taking this 9% for the 3 years, right? So just taking the annuity formula of uh, of this 9% and multiply with your amount, interest amount, my liability would be there, right? My liability would be there. So in this case, 2 million is your proceeds. You have already calculated the liability part, which is 1.8 million, right? So rest of the amount will go to your equity. So in your balance sheet, you will show 1.8 million as a liability part, 1.5 million as an equity part. Then again, you will unwind, you will apply the unwinding of discount formula on the 1.48, right? At the year end third, whenever you will convert this liability into the equity portions, this liability will get converted into equity and will get reflect into your Shoshi part under the equity part. At the initial stage, your equity would be your 1.5, 1,51,000. We can say that. So, if you summarize this compound instrument, I can say that rather than showing this 2 million under the liability part, 1 lakh 51,000 will go to an equity part, 1.8 18 lakh 48,000 will go to your liability part, right? So equity will remain into equity till the time your all liability will get converted into the equity part. So that is called these compound instruments. So you need to keep in mind this logic to take the discount rate of the non-convertible debt which is available into the market. So that is called these compound instruments. Now come to the next stage, which is called the treasury shares. What is the treasury shares? So if an entity requires its own equity instruments in the market, it's called the treasury shares, right? So you can see the Reliance Industries balance sheet or some big corporate sectors. So they have buy out the shares and they this is called the treasury shares. And this will be deducted from the equity. No purchase, no gain and loss will get recognized in terms of the treasury shares part. Might be that in some cases, the treasury shares, an entity holds the shares on behalf of the others, means through the agency relationship. Suppose in terms of a bank, right? An industry has taken a loan from a bank and pledged the shares to the bank. And might be that the shares is in the name of the bank itself. Now, the standard says that this shares which is held by the bank in agency principal relationship, agency relationship, you don't need to recognize those treasury shares, right? You don't need to recognize these treasury shares. This will be called as a collateral or the pledging part. So this will not applicable in case of the treasury of the agency relationship, principal agency or customer agency relationship. But yes, if you buy from the market, then it will get deducted from the equity itself. So Ind AS 1 states that as and when this type of transactions would be there, you need to disclose it either on the face of the balance sheet or into the notes to accounts that this transaction has been happened, means whatever the invest instruments you have taken from the market, as well as from the Ind AS 24 related party disclosures if it's this instruments has been brought from the related parties, right? So this is called this treasury shares. So it will always be deducted from the equity itself. Now come to the next one relating to the interest, dividend, loss and gains. So as we discussed under the liability and the equity part, so interest means interest, it will part of your P&L, right? It's a very simple thing. But as and when your liability will get converted, your equity will get be part of your liability, means preference shares, as we discussed in the previous slides. So whatever the dividend you will pay to the preference shares, redeemable preference shares, which will be part of your liability, it will be your interest. Under this Ind AS 1, you need to show under the finance cost, right? So that's why this difference or this differentiation is required between the liability and equity part, specifically in terms of the preference shares capital. So dividend will become your interest part. So distribution to the holders will always be part, or will always be part of your equity. Means it will get deducted whenever your dividend you have, whenever the dividend you will declare, it will automatically be part of your equity portion. It will get deducted from the equity itself, right? So the difference between the liability and the equity is that liability will get measured at the year end, but equity will not get measured. Equity will remain the same. So that's why this difference is required between the liability and equity. This will get impacted on your interest and dividend part, right? So that's why this dividend will get converted into the interest part, and the presentation will get differ under the finance cost as per this Ind AS 1. Now come to the last topic, last slide of relating to this Ind AS 32, offsetting. Offsetting a financial assets and financial liabilities. So this is a new concept that were not there in the Ind AS, in IGAP. But this is offset of a financial assets and financial liability. So offsetting arrangement means I can offset. Suppose I want to take, I want to receive a money from a particular party, and I have to pay some amount to the same party. Whether this offsetting is required, means receivable minus payable is required. If required, so what is the need of this offsetting? So standard says that offsetting arrangement allow a particular participant to manage their credit risk, their liquidity risk, right? So to reduce the credit risk, market risk, and the liquidity risk, the standard says that the offsetting is allowed, but it is allowed only and only when the currently has a legal enforceable right. Legally, might be that under the Indian scenario, under the insolvency and the under law, whenever the company is into the insolvency stage or under the liquidation stage, that law will not allow to set off, right? So we need to keep in mind each and every scenario while applying these offsetting rules. So currently has a legally enforceable right to set off the recognized amounts. And the second and the most the important fact is that intents either to settle on net basis or to realize the asset and settle the liability simultaneously. Their intention should be there that I want to settle it into the net basis. But this transactions is normally happen in terms of the banking part of financial institutions part, wherein in case of the broking house or in the clearing house, one some amount you have to pay, some amount you uh, need to receive. These types of transactions can be settled out. But for the settlement part, master netting agreement should be there, right? Master netting agreement wherein the all terms and condition will get specified, how much amount you can settle it out, what are the conditions. So all conditions you need to settle it out in the master netting arrangement. So suppose you have specified your master netting arrangement, but you don't want to settle it. So disclosure need to be given under the 107 part. So if you have offsetted the amount, trade receivable, payable, or any type of offsetting, you need to specify. You need to mention in your disclosure part. So, and in the worst scenario, you have made the master netting agreement, but you do not apply the offsetting rules. Again, you need to disclose under the 107 part. Now, this offsetting means that you will offset particular item with you the another item and the another party. But this offsetting is differ from the derecognition parts. Means the under the offsetting part as well, you will remove the particular item in your balance sheet. Under the derecognition means you will again remove the item from the balance sheet. But there's a difference between this derecognition and the offsetting. Under the derecognition, you will recognize gain and losses, but under this offsetting part you will don't recognize gain and losses. So that's the difference. So sometimes people ask, is there any difference between the derecognition and the offsetting? Yes, the difference would be there, but in case of derecognition you will recognize gain and losses, but in the offsetting part, no gain and losses will get applied. So this is called the offsetting rules. Legally enforceable, you have to check for each and every condition whether it is legally allowed to offset the amounts, and it's my intention, whether it's my intention to settle on the liability and assets on a simultaneous basis. Suppose we can take one example. Suppose a foreign branch of a US bank makes a loan to a foreign subsidiary of US parent, with the parent required to deposit an amount equal to the loan in the US bank for the same term. The terms of the transaction means a foreign branch of a bank has given a loan to my subsidiary, and the bank has asked me as a parent company to deposit the amount in my bank account. So now the question is whether the bank has a legal right to set off the amount which the bank has given to the subsidiary, and the balance which the bank has taken from under the parent company. So whether the same can be allowed or not. So it's a bank's legal right to set off. But again, we need to check whether the enforceable rights would be there in a particular law in a particular country to settle the liability and assets on a simultaneous basis. So this is called this financial the offsetting part, right? So under the offsetting, it's a very new thing, but we need to check the law of a particular situation, right? So that was all about this Ind AS 32 part. Now let's take one brief discussion on this 109 part, right? 109 is relating to the classification. We will discuss about the classification and the measurement part of this Ind AS 109. So under this 109 financial instruments part, so we will discuss this into two categories. One is financial assets and one is the financial liability. So first, let's first discuss about the financial assets part. How would you classify the financial assets? There are two methods, or we can say that there are the two broad categories of this financial assets part. One is amortized cost, and second is the fair value. Under these two methods, we have to classify, we have to measure these financial assets. Again, this fair value, there are the two separate methods, separate parts under the fair valuation. One is the fair value through profit and loss. In short term, we can say that FITPL. Another is the fair value through other comprehensive income. So when we talk about this fair value, because this financial instrument is based on the fair valuation method, fair valuation basis. So definition has been prescribed under this Ind AS 113. What is the fair value? Fair value is based on the exit price, whatever the amount you will get by selling a transaction in an orderly manner. That is called your fair value. It's not an entry price, it's your exit price. So separate standard has been prescribed for the fair valuation method under this Ind AS 113. So we need to keep in mind these two things, amortized cost and the fair value. And under the fair value, again, there are the two separate criteria for this classification part. One is fair value through profit and loss. Second is fair value through other comprehensive income. When we talk about this when we talk about these financial assets, these financial assets we can categorize into two parts. One is your debt investments. Second is your equity investments. So for this debt investments, it's a bit complicated. Just to understand the things, we need to analyze two models. So that means you have invested in sort of bonds, debentures. But the question is, how would you identify whether this is my equity investments or is my debt investments? If you invest in the equity shares, that's a very simple thing. It's your equity investments. But it might be that you have invested into the preference shares, but you need to look whether the redemption conditions and the other conditions which has been classified by the issuer will be part of my debt investments or my equity investments. So this classification you need to see at the issuer level, right? At the issuer level, because this Ind AS 109 is applicable for the holder's point of view. So holder need to check whether that investment, how the issuer has classified this investment into the debt part or into the equity part. So we need to take those classification in terms of the recognition in our books of account as far as the holder part is concerned. So now let's take the debt investments. How would you recognize this debt investment in our books of account? Two models, two methods, two models we need to discuss. First thing is that contractual cash flow solely payment of principal and interest, which is called SPPI. What is SPPI? Solely payment of principal interest. It basically means just having the basic lending arrangement. Suppose you have invested into the debentures, you will get interest on the regular basis. It's a basic lending arrangement. On simple terms, we can say that, okay, this contractual cash flow payment principal interest criteria has been meet out. Okay, then we need to check the business model test. What is the business model test? The business model test means that as a decision maker of a company, how I am mitigating my risk in terms of the treasury part, in terms of the financial instrument part. So this business model test will get categorized further into the two parts. One is relating to the whether my intention is to hold the investment, hold to collect the cash flows, and hold to collect and sell the assets method. What does that mean? Hold to collect means that till the maturity of the investments, I will earn interest. I will not make a sale unless and until some worst scenario, worst condition has been meet out or has been incurred. This is called the hold to collect. Suppose I've invested in the debentures. The term is 25 years. I will earn 6% of interest. Till maturity, I will earn interest. My intention is to hold to collect. This is called hold to collect. Second thing is that hold to collect and sale. What does mean by that? By meeting my liquidity needs. I have invested in a particular day. If in the another day the returns are high, I can make a sale and earn a profit. In the next subsequent day, I make further investments. In the next day, suppose in the next week my returns are high, I can make it a sale. That is called the business model to collect and sell, right? So there's a separate discussions for these two standards, two models. So now, first thing is that the SPPI test, solely payment of principal and interest model has been meet out, means the basic lending arrangement. Okay. Then we will need to the business model level test, means my intention is to hold to collect or hold to collect and sell, right? So these two things we need to keep in mind. So now we are presuming that my first condition has been meet out. SPPI test, basic lending arrangement has been meet out. Then I am now analyzing my business model. If my business model is to hold to collect contractual cash flow, I will categorize or I will measure under the amortized cost. So what is the amortized? We will discuss it. So this is the amortization cost method. If my business model is to hold to collect and sell, then I will classify or I will measure at fair valuation through other comprehensive income, which is called FPOCI, right? So two things, amortized cost or fair valuation through other comprehensive income. If suppose my first condition has not been met out, SPPI test, the basic thing has failed. I have not met out the basic things. What we need to do? I need to categorize under the fair valuation to profit and loss part, right? So three things. Either you can do or you can measure it under the fair valuation through other fair valuation through profit and loss, or fair valuation through other comprehensive income or amortized cost. So I believe you are aware about the other comprehensive income part, right? So let me brief about it. So Ind AS 1 says that under the profit and loss parts, two things. One is the profit and loss, and the below item is your other comprehensive income, right? So under this other comprehensive income, items are those which can't be part of the P&L part, like the revaluation reserves, pension benefit, actuarial gain and losses, fair valuation of this debt and equity investments, right? So under this OCI, this portion under the debt part will be part of the this fair valuation will be part of the OCI part, right? Now come to the equity investments. Suppose you have made an investment in the equity part. So in the equity, simple thing is that the SPPI test will not get metered because the basic lending arrangement would not be there. As simple as that. What are the options left out? Two options. There is no any amortization method because this under the equity method, two methods would be there. Either you can apply FITPL, fair valuation through profit and loss, or fair valuation through other comprehensive income. Two methods. The SPPI test will not be there, right? So that means FITPL category criteria would be there as under the debt investment part. If I am having an investment and if I am holding this investment for as an held for trading, it will be part of FITPL means I am trading on day-to-day basis, fair valuation through profit and loss. If not, there's a one criteria left, which is called fair valuation through other comprehensive income, FIOCI. So now, under the debt part as well as under the equity part, one method is common, which is called fair valuation through other comprehensive income. But there's a difference. There's a difference. What is the difference between these two? The standard says that under this Ind AS 109, for the debt investment part, which you have measured at fair valuation to other comprehensive income, the same will get parked or same will get reclassified to P&L as and when you will make a sale or as and when you de-recognize your assets, right? But in terms of equity, as and when you classify or as and when you measure out your investment under the fair valuation through other comprehensive income, the same will be permanently parked under the OCI part. That will not be reclassify under the P&L part. So that's the difference between these two, debt and equity, right? So in terms of the debt instrument part, for the fair valuation to other comprehensive income, fair valuation will go to the OCI part for the debt part, right? All other items means interest part, foreign exchange gain losses, impairment part will be part of your P&L. But in terms of equity part, except dividend, whether it's your impairment loss, foreign exchange gain loss, all will be part of the OCI. So there's a difference between these debt investments and the equity investments. So that's why this discussion is required, because this is a very common thing for each and every industry, because every company normally doing the transactions in the debt investment as well as in the equity investments, right? So for the equity investments, permanently amount will get parked, but for the debt investments, that's the same will get reclassified into the P&L as and when you will make a sale. Again, for this classification of financial assets between debt and equity, how would you recognize or how would you see the things from the issuer point of view? Because this 109 will get applicable from the holder's point of view, but for some transactions, how would I classify whether it's a debt investment or equity investments? We need to see the classification of the issuer, how the issuer has classified the transaction into their books. So that is the classification of the debt or equity part. So we can spend 10 or 15 minutes, 10 minutes in the next slides. Business model assessment, right? So as we discuss about the classification part regarding this business model assessment, so we can understand the terminology in a much broader way. How this business model will get classified or much having a relevancy in terms of the financial instrument part. So two things we have discussed: business model. So this business model will be applicable for the debt investments only, not for the equity investments, because under the equity investments, two things: either you can use your FITPL or fair valuation to other comprehensive income. So for the debt investment, we have to see the business model, right? So business model could be two types: hold to collect or hold to collect and sale. There's one another business model which is called the residual business model, wherein you want to apply the FITPL method at your own level, right? So this assessment, how would you make the assessment? Okay, I want to apply hold to collect or I want to apply hold to collect and sale. You can't do on instrument basis. You need to categorize the investment in a particular category at a higher level and do your assessments. Might be that a company is having 4 or 5 business models in their corporate sector. Sector A would be your hold to collect, sector B would be your hold to collect and sale, and sector 3 would be your residual value, means you can classify your investment as per the FITPL category. But when in terms of this business model assessment, hold to collect, so as we discussed that I will earn the investment, I will earn the interest till the maturity time. But might be that I need to make a sale in case of the some stress scenario, in case of the worst scenario, that can also be allowed. Might be that your credit rating will get out, will degraded by these credit rating agencies. So in that case, you can sell before maturity. So that is allowed. You need to check the prior conditions as well, prior transactions as well, right? So as and when, but the sale transaction should not be significant, it should be insignificant, right? So in the case of the hold to collect, yes, the sale will get allowed, but not in the significant manner, right? So suppose entity A has a portfolio of financial assets which is part of hold to collect business model. Due to change in the legal requirement, entity A has sold some of the assets and has to significantly rebalance its portfolio. So due to the legal requirement, some assets has been sold out. Now the question is whether the company need to revisit its business model. Means the company need to reclassify from particular A to particular B type of the category of the measurement of the financial assets. It's a one-time scenario, right? So company don't need to consider the revisit of the business model assessment. Hold to collect and sell business model. So it's basically a management intention to how the management want to see or want to mitigate their risk in terms of the treasury part, right? So it's part of the integral processing, integral reporting for the KMP, or which we can say that the key management personas. Either they want to have a liquidity risk, liquidity needs, or particular, or to recover or to get the higher returns on day-to-day basis, right? So it's basically part of the decision maker policy whether the company want to apply a hold to collect business model or hold to collect and sell business model. Suppose a company A is planning a capital expenditure in 5 years. For funding the expansion, entity A invested funds in financial assets. However, the maturity of the financial assets doesn't match with the period of capital expenditure. Entity A might hold the financial assets till its maturity or well, right? So, and well sell before will sell before maturity if they fetch higher returns. So, remuneration of the portfolio managers is based on the return from the assets. So, in this case, the company is invested and the company has their expansion plan as well. But the thing is that as and when the returns will get higher, the company can make a sale. So that means it's hold to collect business model. It's not hold to collect and sale business model, right? So because the company will get the returns as and when the market will up. So right, so in this type of the question, so in this type of the scenario, you will get analyze whether the transactions would be part of hold to collect. Hold to collect means amortization cost method would get applied, and hold to collect and sale means fair valuation to other comprehensive income will get applied. So other categories fair valuation through profit and loss. So why it is important to analyze this the third category. See, suppose company is having a liability, and the liability is being measured at fair valuation through profit and loss. And this liability, the company has invested in some sort of investments, right? So company want to mitigate or eliminate their fair valuation mismatches. Means if a liability is being measured at fair valuation through profit and loss, asset should also be measured at the fair valuation to profit and loss. Otherwise the mismatches would be there. Might be that my assets would be at amortized cost, my liability against my liability would be fair valuation. So in that case accounting mismatches would be there. So we can identify or we can apply the fair valuation at our own level just to eliminate the accounting mismatches. So in that case fair valuation through profit and loss can apply if the company can make the judgment or can make the reasons that why we want to apply the fair valuation model, fair valuation through profit and loss model in a particular transaction. So this SPPI test, right? So it's a basic lending arrangement. So basic lending arrangement constitutes of two things. One would be your principal part and another would be your interest part. So principal is your fair valuation of your financial assets and the fair valuation of the financial assets at the initial recognition, right? So principal, and the second part is your interest part. Interest would be your time factor, which will be passage of your time, and another is your credit risk, right? So so means you can understand the transactions that these transactions are part of my basic lending arrangement. Only and only in that case you will categorize this investment into a particular category, either the amortized cost or under this fair valuation to other comprehensive. But again this will be applicable for the debt investment, not to the equity investments. So again, this consideration time value money, we have already discussed about that. It will be part of two things. One is your passage of time, and the second is your normal interest rate. But might be that, suppose why it is important in terms of the bank loan part, right? You have taken a loan from the bank. So banks PLR rate, banks prime lending rate will get changed from period to period. So your liability will get changed period to period. So in terms of the modification part, suppose my interest part is will get modified, right, as compared to my initial amount. What we need to do, if there's a significant modification, so that means basic lending arrangement conditions is not meeting out. So that's why we need to check my interest whether linked to my PLR rate or some sort of equity index or some sort of performance part. Might be that, suppose my interest agreement with the bank is that if my EPS will get lower by 5 times, my interest will get up by 5 times. So these type of the conditions would be there. The standard says that two things you need to keep in mind. If my interest part is relating to the some sort of inflation index, my banking PLR rate is basically linked with the inflation index, that is allowed. That means, because you see that normally when every quarter the RBI came out with the reduction or the increase of their interest rates part as well, so it will impacting my industry as well. So that's why this will get allowed. But again, if my interest part is linked with other than the inflation index, means debtor performance or the EPS part, so that means my basic lending arrangement will not will never be meet out in that conditions. So for the classification of the debt and debt part, the SPPI conditions, two things: the passage of time as well as the interest part. We need to see whether my basic lending arrangement condition has been meet out or not, right? So one example has been given. Instrument A is a bond with stated maturity date. Payment of the principal and interest on the principal amount outstanding are linked to an inflation index of the currency in which the instrument is issued. The inflation link is not leveraged and the principal is protected. See, my interest rate is linked with the inflation index. So that means I can say that my condition is being meted out. Means it's part of my SPPI, basic lending arrangement. In another case, suppose this linkage is relating to the debtors performance or EPS or some sort of the performance of the company. So this condition will be inconsistent with the basic lending arrangement, right? So in terms of the complication part, as and when you will analyze the financial instruments into the corporate sectors, you have to analyze all the factors while applying this SPPI test, whether this SPPI test is being meeting out or not. If not, then by default we have to categorize this investment under the fair valuation to profit and loss. So reassessment of business model. Reassessment means uh, we are applying a particular model, means amortization model, means hold to collect, and the company want to change from hold to collect and sale. Whether this is allowed, we need to check the conditions, right? So what type of those conditions which will allow to change the business model? Suppose entity A holds a group of debt assets originally intended to collect all the contractual cash flows. As a result of the cash shortage, management decided to sell half of the assets. Means it's a one-time transaction. So one-time transaction is allowed. You don't need to visit. You don't need to revisit your business model. So whatever your business model is there, you can stick to that business model. Means it is amortization. Yes, amortization will get allowed. Suppose in the another example, suppose a company has shut down its business, mortgage business, and company want to change their business model. Means some sort of the lending or some new lending has been came in to the mind of the managers of the company. So in that case, the company can change the business model because the particular business has been shut down and the new thing has been come into the business model. So in that case, the business model will get changed. Again, we need to see the particular conditions for each and every industry. So as and when we will reclassify the investments, right? So reclassify means when you change your business model, you have to reclassify your investment. Means amortization to fair valuation or fair valuation to the amortization or a vice versa, right? So whatever the business model you are adopting, you can change as per the requirement, as and when the condition arises. Suppose in case of the amortization, now we are going to cover under the fair valuation to profit and loss. So fair value. So this accounting, this financial instrument is basically based on the fair valuation. So whatever the fair valuation would be there at the time of your, at the time of the reclassification date, that you need to take it out, whether it would be your amortization to fair valuation or fair valuation to other comprehensive income. The difference is that under the fair valuation to profit and loss, it will be part of your P&L, and in case of the fair valuation to other comprehensive income, it will be part of the other comprehensive income. So that's the difference. But the thing is that you need to take the fair valuation at the time of the reclassification dates. All the factors will remain same, whether it would you, whether you want to cover from amortized to fair valuation to amortized, the new cost will, new fair valuation will become your cost factor, right? So that is the difference between this reclassification. But yes, reclassification of the financial liability is not allowed. It's allowed only for the financial assets. So first thing is over regarding this financial assets part. Now let's discuss on the financial liability part. So financial liability, two method has been prescribed. One is the amortized method. Second is the fair valuation to profit and loss method. Fair valuation to profit and loss is applicable only and only in that case you want to do, you are doing a transaction on held for trading purpose, or you want to reduce your accounting mismatch, right? In all cases, amortization cost means, in case of the bank loans, amortization cost would be there. How the amortization will come into picture, I will discuss in the next slides. Transaction cost, right? What is the transaction cost? Transaction costs are the incremental costs that you have incurred while taking a financial instrument or financial liabilities, financial assets or financial liabilities. So it could be your brokerage, it could be your legal fees, it could be your processing fees. So processing fees is the best example just to understand this transaction of this transaction cost. So as we discussed about this criteria of financial assets as well as the financial liabilities. So under the financial assets part, if we are applying this fair valuation through profit and loss model, so we have to recognize this transaction cost on the P&L on immediate basis. Means it will be part of your P&L. If my financial assets are being measured other than the fair valuation to profit and loss, means amortized cost or other comprehensive income, it will be added. In case of assets, it will be added, and in case of liability, it will be get deducted from the originally recognized amount. Like in case of the processing fees. So suppose you have taken a loan, 1 lakh loan from the bank, and bank has taken 1,000 processing fees. This 1,000 will get deducted. We will apply the amortization model method while calculating this financial liability fair valuation, right? So under the fair valuation to profit and loss, it will be part of the P&L. But in case of the other two methods, other than the financial fair valuation to other profit and loss, in the financial asset it will be added, and in terms of the financial liability it will get deducted. So now come to the main part. The amortization cost method. What is amortization cost? So this, in terms of the financial liability part, banking loans, normally you need to calculate under this amortization cost method, because you can't do the fair valuation to profit and loss. So this calculation will be applicable only and only in case of, mostly, not in only and only, in mostly cases in terms of the banking and the financial institutions loans. The amortization cost method means whatever the amount you have initially recognized, 1,000 loans, suppose 1 lakh loan you have taken from the bank, minus principal repayments, you will get the schedule from the bank if the loan term is 5 years. So that means 20,000, 20,000, 20,000, 20,000 for 5 years you have to pay. Then you need to take the cumulative amortization using the EIR. EIR means effective interest rate. How would you calculate this effective interest rate? Effective interest rate means is a rate that exactly discounts the expected stream of cash flows. Your rate, suppose you have taken a loan from the bank which is 8%, 1 lakh loan. Bank can charge 1,000 rupees a processing fees. You need to calculate the EIR. So EIR rate should be equal to the, that will reduce your, or that will reduce your principal amount to the zero in terms of 5 years after taking this transaction cost. And if you have any impairment part, then you will need to reduce. That is called the amortization method. So amount initially recognized plus minus the principal repayments you will get from the schedule from the bank. Cumulative amortization using EIR that we need to calculate. It can be easily calculated from the you can easily calculate from the Excel by applying the EIR formula. If there's an impairment, you may need to adjust in your amortization method. That is called this amortization. But some industry or in some cases it was observed that company applying the straight lining method means if 1000 my processing fees loan is 5 years, so 200, it's not allowed. You need to apply the amortization schedule for particular this loan type of transactions, right? So this same will be applicable for the financial liability part. The formula is same, right? Now let's take one example of this amortization cost, how it would look like. Suppose a company entity A purchases a debt investments with 5 year remaining to maturity for its fair valuation of 1000. The instrument has a principal amount of 1250 and carries a fixed interest rate of 4 and 4.7%. So that means my inflow would be on the face value, right? So 1250 multiplied by 4 and 4.7%. This is my cash flow. So now the company need to calculate this EIR. The EIR has been given in the question itself. Otherwise, you can calculate through the Excel as well. 1000. So by just applying this formula, amount initially recognized means 1000. What is the interest amount as per the EIR? This one plus or minus the cumulative amortization using the EIR. It's a 10%. What is the actual flow on the face value, which is 4.7%? It's a 59. You need to apply this formula, means amortization cost plus EIR rate minus actual inflow. That would be your amortization cost. This 10% will reduce your amount to zero at the end of the 5 years. The amount would remain same. At the year end, the amount would remain same, but on the year basis, it will get differentiated, right? So that is called this amortization methods. You can calculate for the banking loan on the same basis, right? So this amortization will be applicable for the financial liability as well as for this debt instruments wherein the business model is hold to collect. Amortization method will not be applicable for the equity investments. So initial measurement rules means as and when we apply these financial assets or financial liability, the amount should be recognized at the fair valuation. At the fair value. Fair valuation means as per the Ind AS 113. So these financial assets will be two part: fair valuation through profit and loss or to the others part. If it's a fair valuation through profit and loss, the financial assets would be fair valuation on the date of the acquisition itself, because this transaction cost will be part of the P&L. Apart from this fair valuation through profit and loss, the transaction cost will get added to the financial assets and it will get reduced from the financial liabilities. As simple as that, right? So the initial rule says that you need to apply the fair valuation, right? If it's part of fair valuation through profit and loss, transaction cost will be part of the P&L. Otherwise, it will get added to the financial assets and it will get reduced from the financial liabilities. But this fair valuation should be equal to the transaction price, right? So this is the last slide. I can say that it's a very, very important one, which will be applicable for each and every industry. Gain and losses on the subsequent measurement. Initial measurement we have covered about. Now suppose in case of the subsequent measurement part, 4 type of investments which has been mentioned: amortization cost, fair valuation through other comprehensive income, fair valuation through profit and loss, and fair valuation through other comprehensive income for the equity. This is a very, very important one. So when we talk about this amortization cost, this transaction cost will get added as per the formula which just we have discussed. In terms of the fair valuation through other comprehensive income for the debt part, again it will get added, right? In terms of the fair valuation through profit and loss, it will be part of your P&L part. And in terms of the fair valuation through other comprehensive for the equity part, again it will be added. So same thing, whatever we have discussed, we have just summarized into this one slide. In terms of the fair valuation through other comprehensive for the debt part, all other transactions except fair valuation will be part of P&L. Fair valuation transaction will be part of the OCI, right? Whereas in terms of the fair valuation through other comprehensive income for the equity part, except fair valuation, except for the dividend part, all transactions, including profit, including your fair valuation, including your impairment losses, including your foreign exchange gains, will be part of the OCI. The main thing, the main crux of this session is that in terms of the fair valuation through other comprehensive income for the debt part, at the time of the derecognition or at the time of the sale, the same will get reclassified to the P&L. Whereas under this fair valuation to other comprehensive income, it will not allowed. It will be permanently parked under this OCI part, right? The same thing has been given under this slide. For the financial liability for the subsequent part, two methods. One is your fair valuation through profit and loss. Another is amortization cost. So amortization cost means under the banking schedule part, the same will remain, will be applicable for the subsequent years. And in terms of the fair valuation through profit and loss, FITPL method, you need to measure your liability on each and every year, right? So otherwise the function would remain same. So this is the last thing. I will take just 2 minutes for the derecognition part. What is a derecognition? Derecognition means that I have transferred my rights, cash flow rights to another party. I have sold. I made a sale for this particular transaction, particular financial instrument. That is called the derecognition. So derecognition means you have to remove the assets from your balance sheet part. So this is a very common and very basic example just to understand what we have discussed so far. So suppose entity holds a financial asset which is a debt instrument measured at fair valuation to other comprehensive income. The carrying amount of the assets in the financial statement is 5,000. The entity has previously recognized a cumulative gain of 1,200 on the assets in OCI. The entity sells the assets to third party for a consideration of 5,300. The transfer meets this derecognition criteria. This is the crux of this session, right? So this example, because it will cover about the OCI part. How would you classify this OCI into the P&L part? If suppose the debt instrument, this example suppose is related to the debt instrument. My sale consideration is 5,300. My fair valuation gain and losses, which is 1,200, which is parked under the OCI part. So as we discussed that for the debt, for the debt investments, which has been measured under this fair valuation to other comprehensive income, at the time of sale or derecognition, this OCI will get reclassified to the P&L part. So this OCI will get classified into the P&L part, which is 1,200, which has been given in the question. What is my carrying value? 5,000. So balance would be my P&L, right? If suppose this is your equity investment, so whatever the amount which has been parked under the OCI will permanently parked under the OCI, right? So 1,200 will be part of your OCI. 5,300 your consideration. My carrying assets value is 5,000, so 300 is my gain. So in my first scenario, my gain is 1,500. Under the second part, my gain is 300. 1,200 will be permanently parked under the OCI. That is not allowed. So that is a difference between this debt investment and the equity investment. If suppose this is your amortized cost, so under this amortization cost, fair valuation will not get allowed because you will do the amortization schedule and amortization method. So my consideration is 5,300. My the amortization part would be, because this has been included into your amortization part, you need to exclude it. So that means my amortization value would be 3,800, means 5,000 carrying value minus minus OCI gain, which is 1,200. So 33,800 would be my amortization cost. So balance would be my gain. So that means whatever method you will apply, derecognition rule you need to keep in mind, right? So OCI will be reclassified for these debt investments. For equity investment, it will not get reclassified. The same will get applicable for the liability portion as well. Now come to the last one, is the disclosure. So disclosure is a very detailed part which has been given under this 107. So for the balance sheet, whatever the categorization you have made for this financial assets or financial liability part, means amortization cost method, fair valuation through profit and loss, or this fair valuation through other comprehensive income, that you need to mention, right? The same thing has been given under the Ind AS 107 as well, Ind AS 1 as well. Reclassification, if you have revisited your models, that you need to mention. Offsetting rules, if you have offset some assets with your liability, that you need to mention. Collateral, if you have taken the collateral or you have given the collateral for this financial instrument, you need to mention. The main thing is the default and breaches. If you have breaches some covenants for your banks, and in or you are not complying with the conditions of the bank, that you need to mention in the financial disclosures part, right? So statement of profit and loss, the same thing. The fair valuation, whatever the fair valuation would be there for this financial assets or financial liability part, you need to mention, right? So all, it's a very detailed disclosures. The liquidity risk, the market risk, the maturity analysis of your financial liability under the category of 1 year, 3 or 5 year, you need to mention. Means you need to give the age analysis of your financial liability part in terms of the maturity part. Like suppose you have taken a loan, so you have to apply the banding of your financial liability in the Ind AS 107 form, right? So that was all about this financial instrument part. So just to summarize, we have covered this Ind AS 32 and Ind AS 109 part. Two things we have covered. One is the measurement and the uh, recognition part, right? So three things would be there, which will be applicable to specific industries like embedded derivative. ECL would be applicable for each and every industry. And third is the hedging part. Hedging is normally not applicable to each and every industry, but we will cover in the next sessions as the time allows, right? So guys, if you have any questions, so I am happy to take it.
Thank you, Anil ji, for a detailed discussion.
Yes.
There is one question from out of your example only, sir.
Okay.
It is that I just wanted to ask. Let's say, example in case of SEZ unit, if government has given me some relaxation in taxation,
Mhm.
then it will be covered under FA or what?
See, again, we have to apply the logic of the contractual part. If some agreement is there, means if some sort of agreement I have, which has been committed by the authority, that I will get some sort of exemption for the taxation part, yes, definitely it will be part of your financial assets.
Okay. It will not treated as government grant, Anil ji?
Sorry.
It will not treated as government grant.
Yes, government grant could be your financial asset, could be your, but it's a debatable issue, because it depends upon the auditors whether they want to cover as in financial assets or not financial assets. But normally some industries are showing as a financial asset, some industries are not showing under the non-financial assets. But yes, but
Okay.
some, in some cases, suppose the government grants, you have received a money, or you have covered as in uh, tangible assets parts, that is not your financial assets part. If it is sort of incentive, you will get a cash, right? So that will be your financial assets.
So also, sir, we don't have much questions on this session because we have already taken session in such a beautiful manner that things are already in self-explanatory mode. So we don't
Okay.
have much questions on that, and we also have a time limitation with us because it's already 9 p.m.
Yeah.
So thank you very much, Anilji, to take this session in a very detailed manner. People will definitely refer this session later on also to have a better understanding of the things. So I express my sincere thanks and thanks to all the participants also and all the viewers also. Those who will see this session later on also because this session is available at YouTube also. So friends, you can refer this session later on also. So thank you very much, Anilji.
Yes,
So
thank you.
now I am offering from my side.
So if you have, if the participants still have any questions, so my email ID and number has been given, so they can text me at any point of time. I will try to sort out their queries.
Okay. Anilji, there is a quick question that what will be the treatment of EPCG schemes?
Sir, EPCG scheme is basically is a specifically dealt with the industry level, right? So might be if we get the money in sort of two things. If we are getting a concession in terms of the custom duty and the export incentive part, if we will get the in some we will get the concession in terms of the cash part, that is a financial assets. It will get reduced from the custom duty, my obligation part, that is not my financial assets or financial liability. That's your non FI.
No, no. Okay. Okay. Got it, sir. Thank you,
Thank
RLG.
you.
Good night.
So
Good night.
thank you all. Thank you and good night.
Right, sir. Thank you
Thank
very
you.
much.